good morning, everybody. Thank you for joining the next instalment of our On Top of Tax webinar series. As some of you will already know, each of these hour-long webinars helps you keep up to date with various changes impacting UK businesses. And today we've got a selection of corporate tax news that's relevant to UK businesses. And I'm delighted to welcome my fellow partner, Matthew Clark, who's going to give us an update on customs duty and international trade matters, and tax principal Sean Healy, who's going to give us an update on employment tax matters focused on payments in lieu of notice. Okay, and if I could have the next slide, please, Natalie. So that's the agenda for this morning. We're aiming to finish the topics by about 10 to 12 to leave a few minutes for Q&A. And shortly after that, I'll then close the webinar. So Natalie, next slide, please. So just to kick things off, some corporate tax compliance dates for your diary. We've got a number of key deadlines coming up at the end of this month. So for May year-end companies, you've got a deadline for filing your corporate tax return and your corporate income interest restriction return. If you're an August year-end company and you're not a PLC, 31st of May is the notification if you're in the senior accounting officer regime, so to notify HMRC of who your senior accounting officer is. Excuse me. And then if you've got a November year-end companies, you've got two deadlines there to watch out for at the end of May. The R&D notification requirement and a senior accounting officer notification requirement if you are a PLC, so that's 6 months after the end of the accounting period. A couple of tax payment dates that you need to keep in mind during June. So hopefully that's useful. Next slide, please, Natalie. So what I'm going to take you through this morning is some updates on some recent cases that have come through the Court of Appeal. They've all got a common thread of corporate debt matters. One, BlackRock looks at an international acquisition structure and the debt that was involved in that structure. The Quick Fit case looks at excess interest losses, non-trading deficits under the pre-2017 rules, and whether or not the structure that was put in place was effective or whether it gave rise to an unallowable purpose. And Hargreaves is quite an interesting withholding tax case covering back-to-back loans. Now, I could probably spend the whole webinar talking about just one of these cases because they're quite involved. What I'll try and do is just give you an overview of the key points, and those that want, excuse me, those that want further detail, certainly on the first two, I would definitely recommend reading through the judgments because they're very well written, very well reasoned, and actually they give you a good overview of the thinking, the building blocks of thinking behind the decisions that were made. So if we move on to the BlackRock case. So if we start on the right-hand side with the structure, just to give you a little bit of context. So this was a US group that was looking to make an acquisition of actually a US tax resident target. And it's quite common in US acquisitions to have a tower structure with multiple holding companies all performing different functions. So in this one, we had quite a complicated structure. We're involving a number of limited liability companies. All the companies on the screen in grey were US incorporated and US tax resident, and LLC 5 in black was US incorporated but UK resident for tax purposes by virtue of management and control being exercised in the UK. And basically they put some debt into the structure to drop it down, ultimately through debt, then preference shares into LLC 6 to fund the acquisition. And I think what's interesting here, what I took away from it, is I think you have to understand a bit of the history. So I'll talk you through the Court of Appeal judgment in a minute, but it's important to understand how it got to the Court of Appeal through the various courts. So the case was first heard at the first tier tribunal some years back, and the first tier tribunal basically said that LLC 5 and the debt that it was party to did have a tax avoidance motive because the group was looking to gain advantage of interest deductions, but there was an overriding commercial purpose for LLC 5 to be there because it received dividends up through the preference shares and used those funds to pay off the interest. So they concluded that there was a tax avoidance motive, but there was also a commercial purpose, and the tax avoidance motive was not in excess of the commercial motive. They also looked at transfer pricing, and the first tier tribunal noted that the terms of the debt that LLC 5 was involved in didn't have covenants that you would expect to see if it was a third party situation. And the covenants that they were expecting to see was that the dividends up the chain from the preference shares were likely to be in excess of the interest payments it was due to make under the loan. But they concluded that because this was a related party situation, the terms that LLC 5 had entered into with LLC 4 for the loan were what you would expect in a related party transaction. So in summary, the first tier tribunal got comfortable, much to HMRC's displeasure, that the interest should be deductible. HMRC then challenged that, and it went up to the upper tribunal, and they came out with a completely different view on the situation. They said they understood what the group was trying to do. They understood the commercial purpose for the acquisition and the acquisition finance, but they saw no reason for the LLC 5 to be treated as UK tax resident for tax purposes. So they concluded the whole of the loan was for an unallowable purpose because it was tax motivated, and they therefore sought to deny the interest deduction. They also looked at it from a transfer pricing perspective and said, yeah, we understand what you're saying, first tier tribunal, that this sort of situation would have been entered into in a related party situation, but we think you need to look at the actual provisions in the loan agreement. And the fact that there aren't any covenants in there giving you comfort that it could pay off its interest liability means that we don't think the loan interest is on arm's length terms, and therefore, even though we think it's for an unallowable purpose, if it was for an allowable purpose, we disallow the interest deduction under transfer pricing purposes. So two extremes of views from two different courts, and then Lady Justice Falk got hold of it at the Court of Appeal and put everybody right. Her starting point was good news for taxpayers and advisors, and she started by saying tax-deductible acquisition debt doesn't in itself invoke a tax avoidance purpose. Tick, good. However, she went on to say that there were some unique features in this case that actually caused an issue. She said LLC 5 is only there to play a financial intermediary role. All it does is receive dividends and pay interest, does nothing else. The group's board, when they were talking about this structure, were presented with a sort of fait accompli. This is what you're going to do. This is how you're going to do it. These are the benefits. These are the risks associated with it. And they signed off on a fait accompli structure, which she didn't like. She also didn't like the fact that this group had a history of making acquisitions, and all of the prior acquisitions sought to avoid having a UK resident entity in the structure. So she didn't like the fact that this one was different, and the only reason the UK tax resident entity was there was for tax reasons. She also didn't like the fact that the funny structure with the controlling parties, LLC 5 and LLC 6, was a little bit convoluted. The control of the target rested in LLC 6, and LLC 5 had a very passive interest in that vehicle. So it was only there for financing purposes. She agreed that LLC 5 did make a profit. That was a question of fact. But she said the overall purpose of this was to generate the deduction for the interest. So she concluded that in the absence of the tax advantage for the interest deduction, the decision to enter into the loans wouldn't have been made. And that was the main purpose, unlike Vodafone. So overall, she concluded that the upper tribunal was right. There was an unallowable purpose for the loan instrument that LLC 5 was party to, and the deduction should be denied. Just finishing off the other point on transfer pricing, she revisited that in her judgment and said that broadly, the first tier tribunal was right to look at transfer pricing. She noted again that it didn't have covenants in the actual loan agreement, but she said what you do in these situations is look at and analyze the overall economic effect of the situation and take into account informal arrangements and understandings that would arise in a group situation to aid comparability. So although she disallowed the interest for unallowable purposes, purpose motive, she said the transfer pricing position was sound, and that was a relief to lots of transfer pricing advisors, because basically what the upper tribunal had said went against well-established HMRC practice. So hopefully that's whetted your appetite. That was quite complicated, but we'll move on to the next one, quick fit. So quick fit, again, another case that concerned unallowable purpose, but a very different fact pattern here. So Quick Fit some years ago was acquired by the investment group Itochu, and shortly after the acquisition, they entered into a debt reorganization. And the companies in question that are important for the case are Speedy One, Detail Agent, and the Quick Fit Group. I'll focus on those as I go through. Speedy One was a historic finance vehicle that had been in existence prior to Itochu acquiring the group. and had entered into some loan arrangements with other group companies and had built up quite a significant pot of interest losses, non-trade deficits. And under the rules at the time, those interest losses were effectively stranded in the company itself. And there was very little they could do with those deficits unless Speedy One could generate an interest income or a non-trading profit. So Itochu and the group advisors looked at that and thought, actually, yes, we've got some tax shelter here. How can we reorganize our debts to make use of those losses for the benefit of the group? So they did a number of things. The first thing is the existing loans that Speedy One had lent to other group members. They decided they were going to increase the interest rate on those loans from somewhere in the region of 1% on 1.9% up to LIBOR +5, which they argued was a commercial rate at that time. So loans out from Speedy One, they made that adjustment. Speedy One itself had also been lent money by a company called Detail Agent. And on that side and that loan arrangement, they didn't adjust the interest rate to the LIBOR +5. They left it unchanged. And in addition to that, Speedy One also helped ETEL by way of a new loan to help it distribute cash up through the chain to the parent. Okay, so the long and short of that was that Speedy One ended up with quite a significant increase in its interest income. One, from the existing loans that it had lent out with a new interest rate higher, and another interest stream from the new loan down to ETEL, but its outgoings, interest payable, remained unchanged. So that put it in a position where it was generating quite significant interest income, and it would use up those brought forward losses quite quickly. So what did the court say here? So the first tier tribunal looked at this first, and they concluded that actually they agreed with the company that LIBOR +5 was a commercial rate at the time for transfer prices, and because of those pre-existing loans, that those loans had a commercial purpose. So 2 ticks in the box. But they concluded there was a tax advantage generated or accruing to Speedy One because the subs that were then subject to the increased interest rate only did so to benefit the group. And that generated the tax advantage. This was heard again by Lady Justice Falk at the Court of Appeal when it reached her, and she concurred with the first tier tribunal's views that they correctly identified the tax avoidance motive. It was a finding of fact. And she said that whilst there was TP justification for increasing the loan rate to LIBOR +5, she could understand that. But she said, if you look at it from a group position, because you left the Detail Agent loan rate unchanged, the argument was hollow. That borrowing rate hadn't been reset. The taxpayer tried to argue that Speedy One was never paying tax in the first place because of those brought forward losses. So no tax had been avoided here. Lady Justice Falk didn't like that and quickly put that to bed. And she concluded in her verdict that there was a tax avoidance motive, and the unallowable purpose related to two things. One, the benefit that was accruing on the increased interest rate on the existing loans, and the new loan to ETEL that had only been put in place to facilitate a dividend payment up. So overall, probably where we expected the case to end up, but again, clarifying certain decisions that the lower courts have made. She also went up to say that had QuickFit looked at this in the round and just made transfer pricing adjustments for all of the loans involved, they might have had a safer position and got to a better outcome, but they didn't do that, and therefore the judgment fell. Okay, and then finally, we'll have a look on Hargreaves, Natalie. So Hargreaves, the background to this one is it was a property investment group. It had a number of UK subs that were doing some property development activities, and in order to fund those UK subs had received loans from overseas related parties. Hargreaves, together with their advisors, decided that they were going to look at these debts and reorganise them. And what they did was enter into an arrangement with, first of all, a Guernsey third party, and slightly later on, the Guernsey third party introduced a UK sub. And what they said was, what we're going to do here is the interest on the loans that have come from related parties from the UK sub, we're going to assign the benefit of that loan interest first to the Guernsey third party in return for a fee. And then Guernsey third party is going to assign that right to interest to its UK sub. So ultimately, UK sub gets the benefit of the interest and the principal gets repaid to the overseas related parties. And that assignment took place very close to the repayment of the debts. So the debts have been outstanding for some time. Shortly before repayment, the assignment happened, interest went one way and principal went back. And then the overseas related parties used the fee they got for assigning the interest to make new loans down to the UK subs to continue funding the activities. So the group argued that because of the arrangements and because they were sort of happening regularly, that these loans, number one, weren't annual interest loans, so didn't meet the requirements to have withholding tax deducted. They also argued that the loans weren't UK situs, so there shouldn't be a UK withholding tax requirement. And they also argued that because the interest was paid from a UK company to another UK company, that there was no withholding tax anyway. First tier and upper tier tribunals, when they looked at it, disagreed. They said the interest clearly has a UK source because that's what it's being used for on the ground, UK properties. But they said you can't rely on treaty protection because the due procedures haven't been followed. Court of Appeal broadly agreed with that. They said also that because of the continual nature of these loans constantly being refreshed, they were definitely annual interest loans capable of lasting more than 1 year. And because the UK sub that ultimately received the interest only paid back that amount to the Guernsey third party, it didn't really have beneficial ownership of that interest stream, and therefore the treaty couldn't be relied on. So again, another conclusion that broadly makes sense and broadly what we're expecting. So final slide. What can we take away from these? And Natalie, if you can move us on one. So I think the lessons I take away, when you're looking at these cases in the round, advisors and groups need to make sure that there's a commercial rationale and benefit to the company, the wider group, and for the transactions involved in the situation if you're going to get an interest deduction. If you're playing transfer pricing obligations, make sure you're consistent across the piece. That came out in the Quick Fit group. And take advice before debt arrangements are put in place or reorganized, particularly if you're expecting a debt to be short term. Right. Okay. With that in mind, I've set you up, Matthew. Over to you.
Thanks, Neil, and good morning, everyone. So I'm going to take you through a quick update on customs and international trade, some areas of focus that we're seeing from HMRC. I'm going to do a little bit on customs data analytics and a little bit on the carbon border adjustment mechanism. So if we move on to the next slide. Thanks. So just a quick reminder for everyone, the thing with international trade is the landscape moves really quickly and it's very uncertain and it's fast changing. We're 4 years post-Brexit, but you see all the disruption events that happen over the world in recent years. The global trade wars, we've just had Biden put additional treaties and additional customs duties against Chinese imports of EV vehicles and batteries. You've got the Suez Canal, COVID, the container crisis that we had. It just shows that it's a very fast-changing, disruption-led environment. In the UK, there's still a lot of untested law post-Brexit, so I still see a lot of HMRC officers quoting EU law rather than using the new UK law as it should be used. We've had a transition between an old import declaration system to a new one last year. We've still got changes on the Northern Ireland border, and the alcohol regime has changed quite significantly over the last 12 months with additional changes this year. We've also seen 67 new customs-free trade agreements come in with 6 in progress. So it just shows you the sheer amount of change that people within international trade within your businesses have to cope with and adapt to. So on to the next slide. So just a quick thing on customs duty. The customs duty is obviously, it's a tax charged on the movement of goods across an international border. And the main thing you need to take away from this slide is that every customs declaration is effectively a tax return. So every time physical goods move across the border, you are submitting a tax return with data into HMRC. And most businesses will use a customs broker or enable their third-party logistics agent to submit their customs data to HMRC on their behalf. And we'll talk a bit more about that later. So if we move on to the next slide. So hot topics. First one that we're seeing at the moment is that transfer pricing and customs duty valuation seems to be popping up the HMRC agenda. Now, a lot of businesses might not have realised this, but when they brought in the new customs declaration system last year, there are 4 different identifiers that have to be ticked as to whether your relationship between your buyer and the seller for goods you're importing and exporting is actually affecting the price. So in every customs declaration, your broker will answer those 4 questions. So is it a related party transaction? Does it affect the price paid or payable? Are there any restrictions placed on the buyer or the seller? So for example, can you only sell to a company appointed by the seller if you're the importer into the UK? Do you have post-importation adjustments and various different things? So what we've got to remember is if you have a transfer pricing policy in place and you buy and sell to and from related parties in response to your movement of international goods, you're making a conscious decision to assess these 4 statements for every single declaration. Now, a lot of businesses we're finding haven't recognized that this is in place, and their customs brokers are just submitting zeros against all these answers. That means that the answer is no. We've assessed our position against all 4 questions, and we believe that we're fine, and we don't need to indicate that it affects our price. Now, that may or might not be right for your business, but one thing I would say is that you do need to look at these 4 questions. You do need to have an answer that is correct, and then you need to instruct your customs broker as to how to answer those questions on your behalf. And of course, HMRC is increasingly analysing import data, so they will be looking at this in the future. So on to the next slide, Natalie. So inward processing, we had a really big win for Thessencrop this year against HMRC. HMRC previously had said one incorrect line of data, so one import level of data on a quarterly return that was incorrect could effectively invalidate the whole quarter's return. So Thessencrop went to appeal, and it did take them 7 years to win an appeal and get back the £9 million assessment that they'd had to pay. But basically what came out of that judgment is that you can make errors on a quarterly return for a customs duty relief, such as inward processing, but making that error does not invalidate the whole quarterly return. It only invalidates the line for that particular import or export, and that is what you should be assessed upon. So the lessons that we're taking away from this case is that when operating any type of customs duty relief to lower or negate customs duty payable into the UK, the reporting needs to be accurate and on time. It needs to be auditable back to your actual source records, so directly back to your POs and your stock records. And remembering, HMRC can assess 3 years historically for customs duty, so it can be quite costly if they find a mistake and it does flow back for a full 3 years. So we've been helping a lot of businesses at the moment to renew their records, their processes and procedures, and create defence files on their operation of customs duty reliefs. So on to the next slide. So I'm going to quickly run through the carbon border adjustment mechanism. I'm not going to focus too much on the content in these slides because we actually have a webinar coming up on the 20th of June that you're happy to join. And Natalie will send the details of that out later. But if we just go on to the first slide, I'm going to give you an overview of this. So the EU brought in their carbon border adjustment mechanism in October 23. So any importers bringing in products of aluminium, hydrogen, fertilizers, electricity, cement, or iron and steel products into the EU needs to submit CBAM quarterly returns. CBAM's been brought in basically to stop carbon leakage in the EU. So importing businesses shouldn't relocate manufacturing to overseas suppliers where their environmental legislation is less stringent, which means they can use production methods that pour more CO2 into the atmosphere. So that's really the aim, is to lower the CO2 emissions on goods imported into the EU. So the theory is that if you set a carbon price on imported goods equal to those that will be produced domestically within the EU, you disincentivize carbon leakage. So businesses have started to submit their quarterly returns from October 23. The first one was due in January 24. Actual payments for CBAM, so when you start paying the carbon charges, won't start till January 26. And January 27 is when the UK brings in its own regime. What I would say at the moment is there's an awful lot of businesses that don't realise they're caught by this and are being caught out by inquiries by the authorities. So if we move on to the next slide. So what are the teething problems that we're seeing with CBAM? So at the moment, as a UK business, you could either be importing into the EU in your own right of those products, or you could be selling to EU importers that have to report their own obligations, but can only really get the data from you as a supplier. So there's a lot of EU importers at the moment that don't realise that they're caught by CBAM reporting, and the authorities are now sending out letters to catch up with them. Each EU member state has helpfully set up their own CBAM authority, which is completely different and not aligned from member state to member state. So if you have reporting obligations because you import into several Western European member countries, each authority will require you to submit your CBAM report to them in a slightly different way. So obviously not that easy to do. Non-established importers, which you would be if you were operating from the UK and just bringing your goods into the EU, can't report their CBAM reporting themselves. They have to appoint an indirect rep to do it on their behalf. One of the issues with that is often the indirect rep they use to lodge their customs declarations hasn't entered into an agreement with that importer to also do their CBAM reporting, and some of them are flat out refusing to do so. So if you are caught and you are an indirect importer into the EU, you would need to make provisions and agree with an indirect rep to submit those returns on your behalf. So currently the EU is using reference tables for the CO2 values for each of the products by weight. That's particularly easy to work with and not that difficult. That is changing, and by the end of this year, you will be required to report your actual CO2 emissions in the production of your products. That's really difficult because it's quite hard to get that data if you've never collated it before or get it from a supplier that they themselves might not have. So just some of the teething problems there to think about on CBAM. So if we move on to the next screen. So how can we help? So 3 different ways that we're helping clients. First of all, we're helping clients assess, are they caught? And we can do that using data analytics, and we can go through the types of products that they make and export into the EU. We can do training with clients as to how to undertake the reporting, how to pull it together, and help them and show them how to do their quarterly reporting. Or alternatively, for some clients, they decided to outsource their reporting over to BDO, and we're doing that for them at the moment across several EU member states. So on to the next slide. Right, so I'm going to take you through a little bit on Customs Data Analytics tool. I do have a polling question, Natalie, on this, if you'd just like to bring that up quickly, and we can ask the audience just to provide answers for 30 seconds. So quick question, do you analyze your customs import and export data? And there's 3 responses there. No, we don't analyze it. Yes, we do, but it's manually with spreadsheets. Or number 3, yes, we do, and it's data analytics. So if everyone could just take 30 seconds to answer that, and we'll just look at the results. So Natalie, should we start to look at the results now? There we go. So we've got 64%. So we don't analyze import data. 35%, yes, they manually analyze it using spreadsheets. 2%, they use analytics tools. Okay. So if we just go through onto this next set of slides, and then we'll talk about why we think that's important. So we had an old declaration system that was very familiar to importers, but it was 30 years old. I lovingly refer to that as the equivalent of a Commodore 64 PC. And the new version CDS that's 2 years old has an additional 23 data points that HMRC have got, is the equivalent of an officer having an iPad in front of them that analyzes all the data for them. So all their audits now are being data driven, and they're doing very targeted analytics to look at audit questions that they need to go out and ask a business. So if we move on to the next slide, one of the important things to think about is what are they actually looking for at the moment? So what are the hot topics? HMRC are currently auditing the origin of products coming into the UK. A lot of businesses import from the EU and claim preference that those goods, because they come from the EU physically, are actually EU goods, and therefore we can pay 0 duty under the free trade agreement. A lot of businesses claim that using importers' knowledge, don't have the supporting evidence to support that claim to preference. So HMRC are looking at businesses at the moment that have claimed preference to lower their customs duty payable, using importers' knowledge, and are slowly auditing them to see if in fact that assertion was correct and they could claim the duty. We spoke a little bit about valuation before. They are using analytics to start to look at the interaction between transfer pricing and customs valuation. And the other thing they tend to look at is the cost, insurance and freight. Are insurance and freight costs being added into the value of the imported goods? So basically, the main thing to take away is HMRC audits are now underpinned by data analytics. They're more informed than they used to be when they come out and they analyze your business and audit you. One of the important things as well is if you're covered by the senior accounting officer regime, then data reviews really underpin SAO and your business risk review questions. So if you don't analyze your import and export data, you can't really sign off from an SAO perspective that you meet the compliance obligations of that regime, because you're not doing any due diligence on the data submitted by your customs broker on your behalf to HMRC. So moving on to the next slide. We have a data analytics tool. I'm not going to go through that now, but the best thing about a data analytics tool is it establishes an importer-exporter profile for your business, and then it says what is outside the norm, so what doesn't look right. I've got businesses that are reporting tens of thousands of imports and exports a month and cannot possibly review their data manually. They have to use a data analytics tool to do it properly. And the tool that we use and work with them just spots all those potential risks and opportunities to go through. So just moving on to the next slide. So we've got 2 case studies there. Won't go through these. Please read through them in your own time. Just conscious of time, and I need to pass on to Sean. So just moving on to the next slide, Natalie. So if you are interested in CDAT and customs data analytics, I really do think you should be analysing your import-export data. It's very unusual to outsource compliance and submission of a return to HMRC, but for you not to do any due diligence on it. We can really help with that. It's a really great tool delivered online through our portal. If you're interested, please get in touch. And there's 2 links there to look at. The 1-minute video that takes you through the tool is fantastic to explain what it can do for your business. So I'm going to stop there, Natalie. I think we pass over. We're then on to Sean. So Sean, over to you.
Thanks, Matt. We've lost a slide here, but I'll just go through it. Some key deadline compliance dates for you to consider. So in 9 days' time, we should all be completing our short-term business visitor reporting, obviously handing P60s to employees. And those of you that are already payrolling benefits need to be issuing statements of the benefits you've payrolled by the 31st of May. Obviously, 19th, 22nd of June, depending whether you're electronic or not, we have our monthly payments of Peugeot and NIC to make, followed by on the 4th of July, that's your actual deadline for any employment-related securities to be reported. You can report them at any time after the end of the tax year, but that's the final deadline. And then, as we've got here, a couple of days later, we have to concern ourselves with the P11Ds, former employee benefits, etc. And then again, the cycle continues with July. And I've also missed one, which is on the 5th of July is your deadline for your PAY settlement agreement to be sent into HMRC. Next slide, please, Natalie. The other deadline that isn't on the screen is we're seeing a lot more increase in clients having to sadly deal with termination payments with employees as workforces change. So that brings its own deadlines, whether that's through the pressure of getting a job done by a certain quarterly deadline or just agreeing with the individual concerned by a set deadline. So we thought we'd just go through some of the basics to remind people about what they need to be conscious of in this scenario. So next slide, please, Natalie. Taking you back to those of us that are tax qualified, tax school, this is the sort of typical understanding of the type of bits that you have in a termination payment, some of which is definitely taxable, some might be depending on its style, and I'm not going to go through each point here, but that's the sort of general understanding we find of what people think goes into a termination payment. Next slide, please, Natalie. actually, things have, that slide is a little bit out of date now because we've moved on to a new set of legislation from 2018 that's still not particularly well understood, we find. And the Revenue has changed its, pushed the government to change the legislation to introduce something called a post-employment notice payment. And as you can see indicated on the slide there, it sort of taxes quite a lot of what we all used to call payments in lieu of notice that Neil mentioned right at the beginning. Pretty much they've been replaced by this post-employment notice payment. However, the reality is, if we can go to the next slide, Natalie. What we do find in practice is the post-employment notice payment does gobble up quite a lot of the actual sum that you want to pay the employee. So a lot more can be liable to tax in both employees and employers' national insurance. So it's really important to try and make sure we get those bits right. Next slide, please, Natalie. So this is because we've got some new legislation introduced. So everything you give an employee to do with their termination, as we put there, is actually called a relevant termination award, with the exception of statutory redundancy and small pieces that happen occasionally where we have payments in respect of change of duties and change in earnings, which is a very rare occurrence. And also, sadly, when somebody passes away or we have somebody leaving solely for disability reasons. So this is a new concept to get one's head around, and it has changed how we look at termination payments in full. And next slide, please, Natalie. And going back to this post-employment notice payment point, there is a very simple formula, but it's very complex to get the components to that formula. Once that formula is calculated and used, it generates a number that the Revenue says this is your post-employment notice payment. And if it exceeds the whole value of what you're prepared to pay that employee, then it's all liable to tax and national insurance. So the old adage that one gets £30,000 tax-free, I'm afraid, is often not the case now. If the overall payment, once we've done this calculation, is less than the overall payment, then we can potentially access that 30k still. So it's quite a complicated process to get the data together to be able to make this assessment and then pay the payment in a compliant manner. Next slide, please, Natalie. So we have this 30,000 threshold, and I won't go into all the points on here, but it's just worth remembering it applies, can apply to on more than one occasion. It can be used in various chunks. And if you're receiving payments, for example, from various businesses within a group, you just get one £30,000 threshold for your employment. Next slide, please, Natalie. So we recognise that this is a nightmare for clients to work through. So what we've been doing is developing a calculator tool that tries to take away all of this pain. And similar to Matthew's tools, what we're trying to focus on is have something that, as long as you can pull the data together, you don't necessarily need to have any tax knowledge to make the calculation properly. It'll generate a report which you can share with your employee if necessary. And we do this along line with Matthew in the way we're developing our services with BDO through an online portal. Next slide, please, Natalie. So the way we allow clients to work with this calculator is very simple. We give you access through an online portal. You load up the employee data, and we'll show you a screen on showing you how that works in a minute. And then that generates a report normally within 24 to 48 hours with all relevant details. And again, we'll go on to show you that in a minute. But it's a very simple process to engage with, because we often find that when a termination payment is being made, time is of the essence. There's not a lot of time to get things done. Next slide, please, Natalie. So you just like this just shows you a screenshot of our data capture tool. A lot of questions on there, but it is intuitive. If you enter, say, for example, your employee has worked overseas, there are a load of questions to ask. If it hasn't, it doesn't ask you those questions. And for those of you that are into the detail, you should be aware that there are up to 63 different bits of data that we might need to analyse to get that right. I hasten to add, Most of the times they won't be applicable, but it just illustrates how complex this is. Next slide, please, Natalie. And this is a little view of the report that the form generates. The figures are at the top. It then has some general notes that show you, that help you and the employee understand, specific notes that appeal in certain circumstances, and then a replay of all the data. So if there's any worry about what you've told us, what the employee has told you, it's all reported back to you, so there can be no doubt on what facts the calculation has been based. Next slide, please, Natalie. So just as a quick recap, and apologies for the speed, but we're trying to catch up a bit of time here. The calculator we use doesn't require any detailed knowledge. It gives you signposts to the various questions you need to ask. It can cover domestic and international scenarios. So we've got employees that work overseas, then we can pick that up as well, because it does get really, really complicated. And behind that, of course, there are going to be times where you do need to ask some more detailed questions, and we're behind the scenes to help with that. But again, to simplify the process, we're offering this on a sort of a fixed fee for a fixed time period basis. So you know where you stand and can generate multiple reports for different employees, or indeed a category of employees that all have exactly the same circumstances. So we've got a poll question as well here, I think, Natalie, if you'd just like to load that up, please. So just very simple. It's just a snap poll to think whether you feel that a tool, a calculator like this would be helpful. We're hoping you are, but it'd be interesting to see what your views are. So if you'd all like to just give us a yes, no on that, that would be helpful. Well, that does seem like a very positive result, that 80% of you feel that that would be useful. That's really handy to know. And I do apologise for cantering through some of the points, but as we're trying to pull ourselves back into time. So I'll stop and hand back over to Neil for the Q&A, and all the slides will be with you after the event, so you can pick up any of the detail that I've not had time to cover.
Thank you very much, Sean and Matthew. So if I see there's a couple of questions coming through the Q&A slot at the bottom of your screens. So we'll pick those up in the 5 minutes that we've got left. But just to kick off, Matthew, first of all, to you. So thinking about audits of customer data, customs data, are you seeing a lot of challenge around that from HMRC?
I think we are, Neil, and I think increasingly, as I've said, the audits are now being data driven. What we used to see was HMRC officers coming out almost, I would say, a little bit on a fishing expedition, if that's the best way to describe it, asking questions of a business and then getting those answers and then taking action based on those answers provided to them. I think now most officers, they're using data analytics, using the MSS import and export data. So they're already coming out to the business with the areas they think they need to audit and they need to focus on that don't quite look right to them, or that they want to know more information or have got questions on. So on that basis, I always think when you know you're going to get a visit and an officer's coming in to see you, I think undertaking data analytics first to showcase any potential areas of risk and address those, or have the answers prepared before the officer comes out. But I think a lot of businesses are being caught off guard because they're far more prepared than they used to be when they come out to audit them.
Okay. All right, thank you for that. And Sean, I'm sort of listening to what you had to say and looking at those sort of pie charts, and it seems to me that termination payments, they're going to have certainly an increased tax, if not fully taxable. Is that the case?
It can be, Neil. The devil's in the detail.
Yeah.
That's the thing, is making sure we analyse all the relevant detail, because there can be some key facts. We've had a case recently where how you define the word allowance will depend whether the whole of a 6-figure payment was taxable or not. So, and there's also other scenarios. For example, if there's any form of medical involvement, physical or mental, and that's why an employee is actually leaving, obviously that can be very confidential.
Yeah.
But that can result in a whole payment falling outside of those rules and being able to pay that on a tax-free basis. So devil's in the detail, and we need the detail.
Very good. And so David Anderson's asked a question. He said, what's the fixed fee for the calculator? Don't be shy, Sean.
I've never been shy, I don't think. We offer this on a time spent basis. So the base price to allow you to access the tool for up to sort of 5 reports for 30 days, we're looking at around £2,000 for that. That's a sort of base price. And then if clients want that for a longer period of time, 90 days or a year, there are different price points for that.
Lovely. Thanks, Sean. And Matthew, just focusing on CBAM, the EU, based on what I've read, seem to be moving away from default carbon values. Have you got any insight as to what you think the UK position will be when it comes into force?
I mean, it is interesting to note that I think businesses are far more comfortable working with a reference table as to the type of goods that they import, and then applying a carbon value and a charge. It's then easy to work out your reporting requirements. Towards the back end of this year, they've got the last quarterly return. They need to start reporting the actual CO2 emissions based on production. It's really hard to get that data, Neil. They're going back to overseas suppliers and trying to get it from them. And also, how do you check the quality of that data that you're getting from those suppliers? All really difficult questions. The UK so far, because of course we've gone through our consultation paper, we've only got a lot of comments coming out from HMRC. They said for at least the first couple of years, they anticipate using default values. And there's certain areas of business where it's difficult to step away from default values. So for example, Neil, we're helping a US business that does a lot of metal trading, and they do a lot of scrap metal trading. And they've basically said into the EU, for scrap metals, well, we have to use default values because we don't honestly know where the scrap metals come from, what the production process was. So we need some way of falling back on default values for that aspect of their industry, because it's just too hard to get actual emissions. So I think the UK seems to be saying, at least for the first couple of years, we're going to use tables with default values, which seems a far more sensible approach to me, to be honest.
Good. Right, and then final question for both of you. What's the one key takeaway you would like to leave with the audience?
I think on customs, what I would say is you can outsource the completion and submission of your customs declarations to a third party, but you cannot outsource your risk. So you have to do that due diligence on the data being submitted on your behalf. Sean?
I'd go back to the point of the devil's in the detail. Make sure that if you're looking at a termination payment, you get all the relevant details, because it can make a big difference to the outcome. Beautiful.
All right. Thank you very much, both. All right, Natalie, if we can just move the slide on. So just a few more dates for your diary. These will be in the slide pack that come out to you. So professional services webinar on the 4th of June. 19th of June is the next On Top of Tax webinar. The webinar that Matthew mentioned about the carbon border adjustment mechanisms coming up on the 20th of June. And then there are various local BDO offices hosting tax and industry forums throughout the month of June. So look out for those. And if you want to register, the links will be in the slide pack. And then just finally, on the last slide, I think most of you have our monthly newsletter, and we're also on LinkedIn. So there's various regular updates that come through that. So feel free to join those. And we look forward to speaking with you soon. So thank you all very much indeed.